try to be patient with guidance, reading the instructions, and most of all, try to be patient with yourself as you try to decipher these interactions, as you try to navigate this, both as a practitioner, with your firm, and with your clients.
Hello and welcome to Simply Tax. It's Friday, February 12, 2021, and it's a big day in the tax world. Yep, it's the official start of the 2021 tax filing season. As we all gear up for a shorter than usual filing season this year, I thought a good way to kick things off would be to check back in with the AICPA's Tax Policy and Advocacy Group and round out our AICPA Advocacy Update discussions that we started in episodes 113 and 114 by talking through a number of areas that the AICPA team is focused on right now. I'm excited to share with you on the podcast today a conversation I had with Amy Wong-Miller and Alex Scott of the AICPA's Tax Policy and Advocacy Group. With so much coming at us lately, I thought that Alex's advice at the top here to have patience with yourself was a great reminder to start things off and frame our conversation right out of the gate. And it's among the many great takeaways I walked away with from our conversation today. So with that in mind, let's learn a bit more about Amy, who is returning to the podcast after previous appearances in episodes 16, 46, and 113.
Hi, Damien. Thank you so much for having me again. Yeah, just quickly, I'm with the AICPA based out of Washington, D.C. I work on our tax policy and advocacy team, and specifically I focus on the individual and self-employed tax TRP, which is just our abbreviation for Technical Resource Panel. I work with that committee, and then also international tax. So that's what allows me to cover things like virtual currency and digital taxation.
Absolutely. And there's a lot to talk about right now for sure, and as we'll get to. But I guess, Alex, I'll welcome you. I know first time on the podcast, and we're excited to have you. Yeah, a little bit about who you are and what you do.
Great. Thanks, Damien. I also work with Amy at the AICPA. I'm also on the Tax Policy and Advocacy Team, and I cover pass-through entities. So I cover partnership and S corporations and handle those issues and advocate on behalf of the profession for pass-through entities. I'm happy to be here and looking forward to discussing a number of issues for the new year.
There are so many of them. And maybe, Alex, out of curiosity, before you joined the AICPA, what was the road that led you there?
I'm an attorney by trade.
Mm-hmm.
Before that, I worked at Bloomberg Industries Group, and I was an editor for Bloomberg, writing content, netting content for the tax portfolios, and a variety of other products for Bloomberg Law and Bloomberg Tax.
I would imagine that would be challenging, but yet, well, the three of us can appreciate this fun sort of thing to do. Well, we do have a number of topics. I know we were kind of trading messages here, getting ready and just thinking about all the things we could be talking about and covering. Amy, you mentioned it already, virtual currency. I know we've seen some updates and there's been a lot coming at us as it particularly relates to reporting since the last time we spoke about it. But yeah, I guess what's new and what should everybody be looking for this year?
Yeah, so the new thing is that everyone, I'm sure, the issue's already on everyone's radar because the question was already on the 1040 last year. But last year in 2019, it was on Schedule 1 of the Form 1040. So it wasn't in the front, and we kind of got used to, okay, this is a new question now we have to answer for taxpayers. This year, what's new is the question is moved to the front of the Form 1040, which is nice because you can't miss it. However, in addition to that, the Form 1040 instructions for 2020 has new language on how to answer that virtual currency activity question. And we reviewed that language and we think there's just a lot of vagueness, like what's characteristics, and a lot of the terms don't have definitions. So we're looking into that, and we're working on a new letter to ask for better definition and better clarity on the language that they're using in the instructions. Also, from the perspective of IRS guidance, last week, IRS Associate Chief Counsel John Moriarty came out in the press with a quote, and he said, the IRS is aware that guidance in this area is needed, but it is just not an IRS priority right now because everything with COVID, understandably, they are not going to get to it anytime soon. So we're sort of in a similar situation where, we have this reporting requirement, but IRS is not able to issue additional guidance.
Yeah, which does make it tricky. And I mean, generally speaking, I know the conversations I have, I feel like there's a lot of confusion around virtual currency perhaps in the first place. And so then they kind of have terms and things like that are not really well addressed. I would think would create some challenges, and perhaps that's the concern.
It is. So essentially, tax preparers and taxpayers, I think they feel forced to answer yes to the question on the Form 1040, the way it's worded, because it seems all-encompassing. And we have a few issues that we're concerned with that we're going to put in the new comment letter, but two of the major ones that I just want to highlight is, for example, one issue is how can taxpayers disclose transactions if they own an interest in a partnership, but they don't know if the partnership received or traded or did anything with virtual currency. It would require that entity to disclose information to the owners. And right now that's not happening. So
Right.
Owners of partnership wouldn't even know if they were supposed to answer yes to that question. Another issue is, which is a huge risk for taxpayers and CPAs alike, is when a taxpayer checks no to that 1040 question, saying, I've had no activity involving virtual currency transactions. They may be answering no because they don't understand and because the definition of the activity is vague, but we don't know what are the repercussions if we answer the question incorrectly. Are there penalties? Are there consequences? That's not an answer we have either.
Which I think that's the concern I know I've heard voiced of, what is it I'm saying no and yes to, and what are the consequences of it? So I guess it sounds like it remains to be seen, perhaps.
Yes, and even though the IRS is not making this issue a priority, we're continuing to prioritize it. So we'll continue to work on it.
Certainly. I don't know, any other items or unresolved issues or things that you would maybe comment on in the virtual currency space?
I think in addition, a lot of the issues actually we submitted in a February 2020 comment letter, and none of them were resolved or answered. So we're going to be reprising a lot of those same requests, kind of like, for example, give us definition of characteristics. Because right now, how it's defined is everything could be included. For example, a lot of kids these days are using Roblox, and you can switch that. So it goes from currency to Roblox, and then you can trade that for other things, other types of coins or other types of things. It's not just for like buying a character on a video game. It actually has some value. Or gift cards that we use now online, or Amazon. A lot of companies are coming up with like virtual coins, and we want to know, are these considered virtual currency? Because based on your definition, it's so vague and broad, all of these things could fall under that.
Yeah, which is, again, seems like a simple yes or no, but there's a lot that goes into that for sure.
Absolutely.
Switching gears a bit here, and again, going down our list of all the things that have changed this year, or new, I should say, we've got some tax capital account reporting requirements that have changed and are new for 2020 for partnerships. Alex, can you give us a little bit of the backstory here, and I guess really what changed and what's now required?
Yeah, it is new for 2020, sort of. It has been on our radar and practitioners' radar for quite some time. However, it will be instituted for 2020, and it is unlikely that it will be delayed again for this year. So we have it, and we will be putting it on the returns for this filing season. But to give some history, I'm going to rewind us back to 2018. So in 2018, the IRS updated the Form 1065 instructions requiring partners to report tax basis capital accounts that had a negative tax basis capital account balance. So that was kind of the first inkling of reporting capital account balances for practitioners. So then in 2019, not only did the IRS require the negative reporting, but they also put on the 2019 instructions that you would have to report tax basis capital accounts for all partners, regardless of whether or not it was negative or positive. However, we did get a reprieve in 2019. There was a delay in 2019, so you only had to report negative balances again. This past summer, in June or July, the IRS released Notice 2020-43, which gave a number of proposed methods and a lot of detail of how this reporting requirement would actually be implemented. We wrote a comprehensive comment letter on that, on the proposed methods, and also requesting that the transactional method be added back as one of the three methods, or proposed three methods that you could use to calculate that capital account balance. So that was kind of the iteration through the past few years of how we got here now to 2020.
What's the goal in all of this maybe as well? What are they after here in requesting and wanting this information to be presented?
It hasn't really been specifically stated. In our comment letter, we kind of directionally assume that it's being used to kind of estimate outside basis and to kind of figure out some of the basis limitations during audit or the IRS just kind of getting to their big data. So we kind of know that the IRS is moving towards a more data-driven approach just kind of across the board. Big data is everywhere. So the reporting requirement is kind of directionally going there, we think, and I think practitioners kind of coalesce this idea that this is what this is really about. So that's the impetus for the reporting requirement that we're now getting into.
So you already mentioned the different methodologies and recommendation there to add one back. Could you kind of unpack those a little bit and kind of, I guess, where we've landed in terms of what the methodologies are that are acceptable?
Sure. And this kind of wraps up into the 1065 instructions released for this year that explain how you would do this calculation for the initial balances for the 2020 reporting year. In November, the IRS came out with the first draft 1065 instructions. And in that, they gave 4 methods that you could use to compute opening balances. And that is the transactional method or tax basis method, the modified outside basis method, the modified previously taxed capital method, or the 704B method. And the modified outside basis method, the modified previously taxed capital method, and the 704B method were some of the methods that were provided for in Notice 2020-43. So those were initially proposed that you could use any of those to calculate and roll forward in calculating the capital account balance. However, in the instructions, there's only one method available, and that's the transactional.
Okay.
So you can use any of the 4 to compute opening balances for this year. But going forward, it appears to be that the transactional method will be the only one available rolling forward for 2020 and 2021. But there is a number of methods that you can use to compute opening balances, which does give some leeway to practitioners if you had not been using the tax basis method historically to kind of get to that opening balance in the first place.
That makes sense. And there's definitely some inherent challenges perhaps in doing that, like you said, if it hasn't been done in the past. And so that does provide some flexibility, but perhaps maybe some confusion. I don't know. Is that something that you're getting a sense of, that practitioners or taxpayers aren't quite aware of that distinction between beginning and go forward at this point in time?
I think there may be confusion in using the transactional method going forward, in that in the last couple of years, practitioners may have assumed that you could use any of the methods and just stay in that lane going forward. So it's kind of, you're merging on a highway and you had 4 lanes and you're going down to 1. But I think in 2020, we are at that point now where we're all coalescing around that 1 lane now. But there is flexibility. So it's more of getting all of those documents together to compute your opening balances. That's kind of where we're at now. But I think using the transactional method going forwards is going to be okay. It's more of the shakeout now of causing traffic, of just, merging down to 1 lane. That's where we're at.
Yeah, and I like that metaphor. I guess, Alex, since we're changing lanes and minding traffic here, I know year of transition can always be challenging, or can sometimes create challenges, I should say. Anything by way of relief or approaching that this year?
Yeah, we talk a lot about penalty relief, obviously, as the practitioner community. I would say penalty relief is the wrong terminology in this instance. I think penalty leniency is more appropriate, and the IRS released Notice 2021-13 recently that gives penalty leniency in calculating the opening balances. So this does give additional flexibility when we're in this traffic area, when you're using any of the 4 methods to compute the opening balances, that ordinary and prudent business care is required when you are computing these initial balances before you roll forward for the 2020 tax year to file in 2021. So what does ordinary and prudent business care mean? I think it's kind of that standard that we all think about, reasonable efforts. It's used in other language of the code, the SSTSs. I know it's a little bit amorphous, but I don't think it's inherently unclear in that way. So we have this sort of fictional reasonable person that we talk about all the time. If I was talking to this fictional reasonable person on the street corner, socially distanced, of course, and this person asked me, what does ordinary and prudent business care mean? And I was just talking to this person as a friend, I would say, well, college effort is required. And what I mean by that is that you would have to use reasonable efforts to compute it. Now, that does not mean that no effort is required, but I think there is understanding that 100% accuracy is not going to be the mark either. There's going to be certain situations, if you get a new client and you're doing a historical recreation of records or something along those lines, that there's going to be gaps or you may miss the mark in 2020, especially if you're using a different method and then you're going to roll forward in the transactional method. There may be differences in the number going forward, but I think ordinary and prudent business care, reasonable efforts, there is penalty leniency for this reporter requirement for 2020. Everyone knows that it is new, and so does the IRS.
I love the way you describe the standard. That's a good way of approaching it and thinking about it, and that you still got to give it that college try at the very least, right? So with that, what's new with the instructions this year as it relates to maybe the tax capital reporting and otherwise?
There is quite a bit of new instructions on the tax capital reporting, all the different methods, everything we just described. I would refer to the notice as well for the penalty leniency. That is outside of the instructions, but good to refer to on all of that standard and whatnot that we just discussed. But as far as what else is what's new, just as a good practice point, right on the first page of the instructions, there's a what's new column. Would generally read that, just good practice tips of kind of what's in there. But in addition to the tax capital reporting, there is quite a bit on the ERC and the interaction of CARES, FFCRA. Now, we could spend dozens of hours on that, and this is kind of beyond the scope of that podcast, but there are some new instructions on that, and we will not have kind of resolution on those interactions, even if we spent dozens of hours on it. But there is some new content in there. And then I do want to mention, this flew under the radar, I think, a little bit, and this was released back in September, and it's a new form for a request to revoke a 754 election.
Okay.
And obviously technical terminations are no longer available. So in September, the IRS released new form 15254. So in order to revoke a 754 election, a partnership has to affirmatively send this form into the IRS requesting a revocation for the 754 election. So there's a few other items on there, but those are bigger ones I wanted to highlight for the podcast.
Maybe switching gears yet again, there's a lot going on when it comes to the taxation of the digital economy as well. And I guess 2020 was going to be, and I think still ultimately was, a pretty big year in terms of developments there. So what's new and maybe what's ahead now that we're, I guess, officially a month in 2021 already?
Yeah, I'll start with a little bit of background because some new, but usually it's kind of much of the same still. So background on OECD digital tax, if any of the listeners have not been caught up on this issue or have always wondered, what's the background, how did this start? Basically, taxation of the digitalized economy has been around and it's been a focus for international tax policymakers since I think the early 1990s when electronic commerce first began. And in digital domain, products and services are uploaded, downloaded, used without any product or person physically crossing international borders. But really it is. So if you have, Apple or Facebook, that's a US company, and people in foreign countries are uploading, downloading, and using those online services. Of course, now international policymakers are trying to think, well, how do we tax this kind of digital economy? Now, there's this international organization or body of organizations called the Organization for Economic Cooperation and Development. And so that's why you always hear the term OECD when you hear about digital taxation. And this organization, what they're doing is they have been studying these issues, developing work papers, and now more recently developing frameworks. And they've been meeting. Many countries have been coming together to meet and try to decide, well, what is the proper framework for this? There's a lot of challenges with it, and one of the biggest challenges of what's been holding this framework back or holding the progress back is actually because if you think about it in the digital economy, you have the US with a lot of digital products and digital services being outsourced abroad. Countries like the US, Germany, China are sort of the leaders in this digital economy space where we have the products and others are using and purchasing it. And then you have all the other countries who are the end users. So when you talk about taxation, it's US companies that will be taxed and the money will be going to foreign countries. And that's why you've seen our Treasury Secretary, whether it be Mnuchin before or even now Janet Yellen, we're thinking that they're probably going to stay on a similar stance because we don't want a framework or a decision to be made on international taxation that harms the U.S. significantly. The biggest news is that last week, Janet Yellen, our new Treasury Secretary, said that she's committed to U.S. participation in OECD talks. But that is the controversy right now. And that piece that's controversial is called Pillar 1. And really, Pillar 1 is about how you allocate profits and nexus rules to capture that cross-border digital activity. So that is the piece that they are constantly trying to meet now all the time. And they say, oh, after this meeting, we'll have a new framework that we'll have agreed upon. And we keep seeing that there are obstacles that they have not cleared up.
I mean, really, it seems like it has implications for pretty much anybody that's in the digital economy, I would think, right?
Yes, absolutely. And that's actually one of the problems with Pillar 1 is that they have not clearly defined what digital services are and who will be included and who will not be included. And without that specific detailed definition of what is considered a digital service, we don't know what's included and what's not.
And I suppose that's probably where some of the challenges, I guess, when the rubber meets the road and thinking we'll get to a resolution or a compromise or whatever, if you will, but then it's probably a lot harder than I feel like it would seem on the surface.
Yeah, they want to make these frameworks, which is broad, but without the details, it's hard for countries to agree to do something and to enter into something like that, especially the U.S., since we're the ones who will be taxed the heaviest, most likely. So the AICPA, we have recommendations and we have brochures and pamphlets that we've put together on our positions on this area. So I'll provide the links, and if anyone's more interested in what our recommendations are, you can take a look.
That's great. I know in terms of what's ahead for this year, what are you keeping your eye on?
I think that we will keep our eye on the new Treasury Secretary, but we don't think that she's going to stray much further from the prior administration on our stance because her responsibility is to the U.S. and how we're going to be taxed. So we don't think that her stance will be much different. And then other than that, I think, it's continue to look at Pillar 1 and how that framework works out because Pillar 2 is the other piece of it. And it's kind of the more detailed aspects of like, dispute resolution, how will we solve these issues? And that is also controversial, but not as difficult as Pillar 1. So we'll be looking towards the months to come as the organization meets more often and see what documents they come out with.
I know there's been some updates and there's been some things going on with Forms 5471 and 5472 and the penalties associated with them. So maybe before we get to the penalties, back up a bit and explain what are the forms?
Yeah, sure. So Form 5471 and Form 5472 are really just informational returns. So the IRS wants you to send them information that you have on foreign transactions and foreign businesses that you're engaged in. So Form 5471 is the information return for U.S. persons with respect to certain foreign corporations, and it's satisfying requirements of Section 6038 and 6046. So officers, directors, or shareholders in certain foreign corporations have to file this information return, sort of just to disclose like, hey, I have this foreign association. Form 5472 is also an information return, and you file it when you have a 25% foreign-owned U.S. corporation or a foreign corporation engaged in U.S. trade or business. It's an information return. As long as you file it, there's no money involved. Now, the issue is what we've seen actually this just came up in this past month, is that you could file an extension. So in COVID, there was an extension available for these two forms because all the tax firms had extensions, and it was a paper-filed extension. And these paper-filed extensions are most likely still sitting in those trailers. So the extensions were filed, not processed, and if you do not file a timely Form 5471 or 5472, the penalties are extreme.
Yeah.
$10,000 for each tax year you fail to file this form, and then an additional $10,000 fine if the information is not provided within 90 days of the IRS sending you a notice of failure to file. So what people are receiving, many taxpayers are receiving this, are these automatic notices that are generated by the IRS for that $10,000 or $20,000 penalty. And it's frustrating for taxpayers. That's what we're hearing. They said, we filed the extension. CPAs are saying we filed all these extensions for all of our clients, but it's sitting in a trailer.
What's the recommendation and what's maybe the hope to see with some of these penalties?
So basically what the issue is when your client gets this automatic penalty notice, it's a CP 504B, that's the notice, and then it's a Form Civ Pen, which is a civil penalty. It is like a lien to, it's an important notice and it's an important penalty, and they freak out and they go to the CPA and they go, what's going on? Like, why do I have this penalty notice? And what we've been telling our members, and we put this in a newsletter, is that when this occurs, what you could do is you could call the practitioner priority service and you provide proof of a timely filed extension. So we've had CPAs reach that service, talk to someone, fax in the extension that was timely filed, and they will note it in the system, and then the penalty goes away. But that is a lot of work for practitioners to go and call the service for every single client that receives a notice.
It is. I will say from my own personal, I guess, recent experience has been, when you do get through and you talk to somebody and you kind of have to be strategic maybe on the time that you're calling and trying to get a low peak time. But I found that those on the phone to be very helpful and willing to help to the extent that, obviously they're able and allowed to do so. But that's really good to know in terms of like a way to approach it. But again, like you said, it's not very...
It's not efficient.
It's not efficient.
Yes. And one more update is that the National Taxpayer Advocate, Erin Collins, is aware of this issue, and she reached out to the AICPA directly, and she wants to help us solve it. So we're working with her and telling her what's happening so that she can at least try to push on her end.
Well, I guess maybe the last topic that we kind of teed up for today, and we'll see if you have any other thoughts to maybe add to it, but 163J, that's been a big topic for the last, we'll call it 3 years now, I guess, that we're in on the TCJA and whatnot and the changes there. But maybe we can back up and get just a little bit of kind of the roadmap to where we've gone and some of the advocacy efforts that the AICPA has done.
So the initial reg package, I believe, was issued in 2018. We had a comprehensive comment letter in response to those regulations. Then late last year, the IRS finalized that set and reproposed a new set of regulations, specifically dealing with most of what they reserved on in the prior proposed set, which mainly dealt with pass-through international issues.
Okay.
We issued 2 comment letters. One was on pass-through issues, which mainly included most partnership issues, and then S corporations regarding self-charge lending. And then Amy wrote a separate comment letter on the international issues in that proposed reg package. The finalized, I would want to say batch, in this instance, was published in the Federal Register on January 19th.
Mm-hmm.
And I say batch because they reserved on quite a few issues in the proposed set that was released last year. And more regulation batches will be forthcoming. I think we can all safely say that. So this is kind of the first set, I think, in many that we can expect to see regarding pass-through and international issues under 163J.
And there are definitely many. And I know, Amy, we've talked some in the past too about the process that the TRPs and your group goes through to help with the committee to land on those recommendations that end up in the letters and the comments that are submitted. I have to think that this one was particularly challenging, just given how many stakeholders there are and the issues that exist. How was it experienced this go around?
It was challenging because, it's great because Alex is easy to work with, but internally this means a lot of committees are involved and a lot of review is required. So that's why we split it up into 2 letters, and you'll see on the international letter, we have some EO recommendations at the end there, exempt orgs. And Alex, he works with partnerships and S Corps. So he focused on the pass-through stuff, I focused on the international, but also we had to make sure that all our groups saw each other's comments so that we were on the same page and that they were approved. And one of our priorities also was that because we go through this thorough process of making sure we have all these review procedures and levels of review, and it requires everyone to be on board with, what the AICPA is putting out as our positions. Because of that slow process, we saw some other comments already be submitted by other organizations, and we wanted to make sure that our comments did not repeat other organizations' comments. So in the end, I felt like both of us tried to keep our letter very succinct to what our absolute priorities are and what we didn't see 5 other organizations say 5 times, because that already made its way to the IRS.
Right. Which, I have to imagine that's like, again, moving target almost, right? Of you're working towards this comment letter, you're adding something, taking it out, refocusing.
Like Alex said, in their next batch, maybe they'll come out with more of the things that we requested. When the final regs come out, Alex and I are both like, looking through and saying, did they give us anything we wanted? And I know from the international side, we had 4 major recommendations and we got one win, one success, which is the treatment of foreign tax expense. And they gave us our recommendation, but the other 3 are still open. So perhaps we'll see something like that in future regulation.
Maybe on the pass-through side, Alex, what were some of the recommendations and maybe what were some of the things that maybe we've seen so far addressed, perhaps as a result of the recommendations in the comments?
Sure. So we had a number of recommendations, and we actually commented not only on the proposed set of regulations, but also on the final set of regulations. Part of the final set of regulations that we commented on, the look-through adjustments, some of the rules surrounding exempt trades or businesses, and then we focused quite a few comments on the tiered partnership calculations. Among others, self-charge lending, debt finance distributions, guaranteed payments for partnerships, a number of issues. Our comment letter was about 30 pages. And then they reserved on quite a bit, particularly, for instance, the tiered partnership calculations, which are quite complicated in the proposed regulations. As far as some things that were finalized, the self-charge lending rule was finalized in the first batch. It is helpful for partnerships. There is no indirect lending rule in the final set, and it does not apply to S corporations. But as mentioned, it is possible in future batches that some things may be refined, or we'll just have to see as we go forward. But we did comment on both the final and proposed set to try to modify certain things that we saw in the pass-through area. And again, as the regulations are finalized or proposed, we do see new things crop up from time to time, which is why we did comment again on the final set, particularly regarding the look-through adjustments. As you mentioned kind of throughout the podcast, a moving target as we see new issues crop up here and there.
I feel like part of the challenge too was sometimes when you have proposed guidance and then even reproposed or final guidance is that things can change. What are some of the things that have changed, I guess you would say, that maybe taxpayers and practitioners should keep an eye on or be aware of at this point in time?
I would say take a look at some of the international rules that were finalized. The self-charge lending rule was finalized for the partnerships. Again, indirect lending is not available, so consolidated groups may want to take a look at that. And then, as we mentioned at the outset, it was published in the Federal Register on January 19th. So there has been quite a bit of discussion, and you can look at webcasts or read blogs on this, but the effective dates and the applicability dates can be a little wonky. So that is definitely something that practitioners and taxpayers will want to pay close attention to in the final, or this batch of final regulations that was released in January.
Yeah.
When are the dates applicable and effective, in which tax years can you apply them to or elect to apply them to?
Yeah, and I guess, Amy, to kind of maybe your point on some of the changes, and I know like you said, you're always flipping to see what's in there. What wins did we get, or how did we influence the final guidance? Obviously, there's some in there. Like you said, one of the recommendations, but maybe hopefully more to come. So we have maybe a little bit more about the wins so far, and maybe what you kind of would see ahead with the future batches and where things would go.
Yeah, so the one thing we saw that we were happy about was the treatment of foreign tax expenses. So Treasury and IRS agree that it's appropriate to determine the ATI of a relevant foreign corporation without regard to a deduction for foreign income taxes that are eligible to be claimed as a foreign tax credit. And this was something that we asked for in our letter. And then also, something else we saw, which I don't think we commented on, but we were happy about, was there on the international side, there was a clarification that was provided that being eligible to make a group election doesn't mean it makes you start your 60-month clock all over again. So in other words, you're only locked in for 60 months if you make or revoke an election. And that's something that we like. And then there's also a safe harbor election that was expanded to apply to more types of groups. And they changed some of the mechanics around determining the eligible amount for purposes of the safe harbor limitation. So those are some things that we were happy to see. But some of the things that we are still looking to see, these are 3 other recommendations from our letter. In the final regs, they're currently saying like this is not likely, but maybe we'll push again and their minds can change. So another item that we asked for was reduction of CFCs, so that's controlled foreign corporations, group ownership threshold to 50%. In the final regs, Treasury and IRS said that they've determined it's inappropriate to reduce the specified group ownership threshold below 80%. But if you're interested in some of our explanations around that, that's in our comment letter about why we say it should be lowered to 50%. Another one is annual election to group CFCs. Treasury came out and said that they've determined taxpayers should not be permitted to revoke the CFC group election for that specified period beginning within 60 months. And an annual election would enable taxpayers to use Section 163J to inappropriately control the timing of the deduction. It didn't fully go against, I guess, what we asked for, but they gave us a little bit of it because you're only locked in for the 60 months if you make or revoke the election, which is better than being locked in for, longer than that, like 5 years.
Sure, yeah.
And then also we asked for application of ordering rules in Section 163J for API determinations because with the ordering rules, there are some things that are more favorable for taxpayers, and we wanted them to confirm what the ordering rules were, and they did not provide the information on that.
Yeah, ordering is a big issue in terms of many of the things I feel like with the TCJA, but that in particular, right? It's a lot to think about. On top of everything else that's been coming at us and changed this past year, right?
Yeah, absolutely. There's just so much going on. I know overall for our members, they thought that, TCJA, the year after TCJA was a difficult filing year. And then now with CARES, they're saying this is going to be a more challenging filing year than ever.
I'm hearing that and sensing that out of the gate. And again, I mean, that's just 163J is almost like the tip of the iceberg to your point, right? Maybe that's kind of a good point it almost brings everything full circle that we've talked about. I mean, I guess we had a brief mention there, right, Alex, of the fact that we could go down the road of, the credits and the ERC and all those other changes on the 1065 instructions. But I mean, that would be a whole nother couple hours of conversation in itself. But other than that, we've not even really highlighted those. And of course, that's been a big change. So let me interrupt myself here real quick to say that if you're looking for more insights on pandemic-related relief, as well as the recent changes to things like the Employee Retention Credit, give our previous episode 117 a listen. And for more insights on how the almost year of pandemic-related developments has shaped the tax world and the things you should be watching for and considering right now, check out our COVID response series and our Tax Season Not Normal series, which you can find links to in the show notes of this episode, available at bkd.com/simplytax. I guess maybe, Alex, from your perspective, any thoughts on the season ahead and kind of how all of the recent developments are maybe going to play in and what we're maybe going to be seeing here?
I think Amy summed it up excellently. There's going to be a lot of interaction. I think there's quite a bit that we are still unclear on those interactions. And I think try to be patient with guidance, reading the instructions, and most of all, try to be patient with yourself as you try to decipher these interactions, as you try to navigate this, both as a practitioner, with your firm, and with your clients. I think we kind of have this saying, we're all in this together. I think try to be patient as much as you can as we all try to navigate these interactions, because sometimes there are no answers out there and we're all trying to get there.
That is really great advice. I don't know that I'd actually thought through of being patient with yourself, because I will tell you and admit that I've gotten pretty frustrated with myself of trying to remember things and feel like I know which way is up anymore, let alone what day of the week or month or year it is to just layer that on, right? So it's a little bit of patience with myself, I think, is something that I need. And I think that's really great advice for anybody, right, in dealing with this. So yeah, well said, Alex. I don't know, Amy, anything that you would maybe add to that, or maybe even just putting a bow on the conversation we've had, which I know we've covered all sorts of issues, and there's no shortage of them, to be sure. Any overall comments that you would maybe leave everyone with?
I think one of the things we have to keep in mind for tax preparers is that we're still catching up on the guidance, so it should be interesting to see how the software is able to incorporate all of these new changes, because it might mean that we have to make a lot of the calculations externally and input into software programs. So that could be extra challenges. But also, a lot of the questions we get from our members are questions that there is no answer to. So IRS Treasury has not provided guidance on your question, and that's why you can't find an answer anywhere on the internet. So exactly what Alex said, patience, because IRS and Treasury are working really hard to push out this guidance. FAQs are constantly coming out. And I think between now and deadline day, we will have a lot more information released and we'll know more.
Moving target, to use kind of the common thread here, right? Maybe one last question I'll ask you guys is, again, we've talked about it on the podcast a number of times, but just how impressed and appreciative I am for all the work. If there's somebody that wants to get involved or help, or there are things that can be even done to help, any suggestions or thoughts on that perhaps, Amy?
Yeah, I'm pulling up our Volunteer Central website.
Okay.
One sec. Okay, so if you're interested in all the things that Alex and I are talking about from an advocacy perspective, and you'd like to work on the committee, because all of our positions are member-driven, all of our issues are member-driven, members tell us this is a problem, we need to address it. You can volunteer for an AICPA tax committee. And if you go to volunteers.aicpa.org, our volunteer application window opens back up on June 1st. So you can get through busy season a little bit. Right. June 1st is when the application window opens.
Oh, hey, sorry. I was just making a note in my calendar here to go to Volunteer Central after June 1st. Well, that's all we have for today. But I'd like to thank Alex and Amy for walking us through a number of important areas that the AICPA's Tax Policy and Advocacy Team are focused on right now. Be sure to pay a visit to the show notes of this episode, available at bkd.com/simplytax, to learn more about Alex and Amy, and for links to the comment letters and other resources mentioned during the episode, as well as a few we didn't mention, like episodes 75 and 82 of the podcast, with more on the concepts of cryptocurrency. And if you're looking for more from me, you can find me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. And one last thing, please let us know how we're doing on Simply Tax by leaving us a rating and review on Apple Podcasts or wherever you get your podcasts, or by dropping us a note at simplytax@bkd.com. We use your feedback to make the podcast better for everyone. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.